Kevin O'Leary just revealed he has sold all of his crypto positions, the Shark Tank star just made one of the most dramatic portfolio moves in crypto history, selling every single one of his altcoins, meme tokens, and speculative positions to focus on just 2 positions. And according to his latest analysis, this isn't just about simplifying his portfolio, it's about positioning for what could be the most explosive phase of this entire crypto cycle. A phase that's being driven by forces most investors are completely missing. In this video, we're going to break down exactly why Mr. Wonderful went from holding dozens of different crypto positions to just 2. We'll explore the institutional buying tsunami that's creating supply squeezes in both Bitcoin and Ethereum. And most importantly, we'll reveal why October could be the perfect time to load up before these moves play out. Kevin has been vocal about his research team's findings, and what they've discovered about market positioning right now is fascinating. But before we jump into it, only a small percentage of you watching are actually subscribed. If you have been enjoying the content or it provides you value, consider taking the 1 second to hit subscribe. It's free, it helps out the channel a ton, and you can always change your mind later. Now let's dive in. Here's Kevin explaining exactly why he simplified his entire crypto portfolio from a total of 27 positions down to just 3.
I also have a whole research team that works on this now. So if I want exposure to crypto, I only need 3 positions now. I used to have 27.
This isn't just casual portfolio management. This represents a fundamental shift in how one of the most successful investors on the planet thinks about crypto exposure. O'Leary's team has been analyzing thousands of different tokens, complex DeFi protocols, and emerging trends. But their conclusion was striking: they don't need any of it. What do you need to own? Well, Kevin believes you just need 3 positions: Bitcoin, Ethereum, and a stablecoin.
But if you look at statistically, the volatility of just Bitcoin and Ethereum and a stable coin for liquidity, pick your stable coin. Some people like Tether, some people like USDC. That's all I need to own.
What's fascinating about this approach is how it strips away all the noise that dominates crypto conversations. No discussions about which layer 1 will win, no debates about meme coin potential, no complex yield farming strategies, just 3 assets that capture the fundamental value proposition of the entire space.
I want a 2.5% weighting in Bitcoin in any portfolio, and I do a 2.5% weighting in Ethereum, and both have performed very well for me.
The precision of these allocations tells you everything about O'Leary's approach. This isn't gambling or hoping for moonshots, it's strategic portfolio construction with specific risk parameters. But here's where it gets really interesting: the yield component.
There's a strategic reason I do that, because I can wrap Bitcoin and Ethereum and get yield on my portfolio every month. So that's what I do. I'm not telling people what to do, but when I own assets, I want yield, I want distributions, I want something while I'm waiting for price appreciation.
This strategy transforms crypto from speculative assets into yield-generating investments similar to dividend stocks or bonds. By wrapping Bitcoin through Ethereum protocols, O'Leary is earning monthly distributions while maintaining exposure to both assets' price appreciation potential. The logic behind O'Leary's concentration becomes clear when you understand what these 2 assets actually represent in the broader crypto ecosystem.
When crypto sort of started, there was a whole bunch of meme coins and tokens and securities, 10,000 of them that are out there. But you don't need to own any of those to get exposure to whatever you think the value of crypto is.
What Kevin O'Leary is highlighting here is the major problem many beginner crypto investors make: complexity without additional benefit. While thousands of altcoin projects promise revolutionary technology or massive returns, the statistical reality is that Bitcoin and Ethereum capture the overwhelming majority of meaningful price movements and institutional capital flows.
And I'm talking about the price volatility of Bitcoin and the alpha that would get to your portfolio if you believed in Bitcoin. So I've taken a whole new strategy since we last talked about this. I'm focusing on 2 securities, Bitcoin and Ethereum.
The term alpha that Kevin O'Leary uses here is crucial. In portfolio management, alpha refers to returns above what you'd expect from market movements alone. O'Leary's research team has determined that Bitcoin and Ethereum provide sufficient alpha exposure to justify ignoring everything else in the crypto space.
If you think about owning crypto, what you're exposed to is price volatility. Sometimes it's good, sometimes it's bad. Sometimes it goes up, sometimes it goes down. But with the advance of a stablecoin act, for the first time we're thinking about, okay, financial services and Wall Street, to put it lightly, they're going to go on chain now.
This reference Kevin is making is to the Stablecoin Act, specifically the Genius Act that passed in July 2025, represents a fundamental shift in how traditional finance views blockchain technology. The legislation provides regulatory clarity that allows major financial institutions to build on public blockchains like Ethereum without regulatory uncertainty. And it's one of the biggest driving forces as to why Ethereum has been exploding upwards in price over the last few months. It's essentially the green light for Wall Street to start building on and using Ethereum.
And you know that because if you want to transact with a stablecoin as a payment system, you need to put it on the blockchain. And which blockchain is getting the majority of that? Ethereum.
This observation is backed by hard data. Ethereum now hosts approximately $165 billion in stablecoins, representing 57% of the global stablecoin market. More importantly, the network has been adding nearly $1 billion in stablecoins per day recently, the fastest pace of growth recorded this year.
And so the only two securities that you see highlighted around the world each day, minute by minute, as they get priced, are Bitcoin and Ethereum. And so if you own those two, you're exposed to over 90% of the alpha and volatility of the entire crypto market. So why own anything else? I don't anymore.
The 90% figure isn't hyperbole, it reflects the actual market capitalization and price correlation data that shows these two assets drive the overwhelming majority of crypto market movements. Kevin's point is simple: if you can capture 90% of the market and upside by owning just two positions, Bitcoin and Ethereum, why own anything else? But O'Leary hasn't always been bullish on Ethereum. In fact, just a few years ago, he was actually very anti-crypto. So what changed? Well, let's now dive into the bullish catalysts that have recently unfolded for Ethereum for him to change his mind and make it one of the only two crypto positions he has. The biggest change in the crypto market that has made Kevin O'Leary bullish on Ethereum is something unprecedented that has begun happening in institutional markets: the emergence of Ethereum treasury companies that are buying up massive amounts of Ethereum at an accelerating pace. The numbers are staggering. According to the latest data, institutional Ethereum treasuries now hold over $22 billion worth of Ethereum, with 73 entities collectively controlling 4.91 million Ethereum, approximately 4.1% of the total supply. Leading this charge is Bitmine Immersion Technologies, which has emerged as the largest corporate holder of Ethereum with over 2.1 million ETH worth approximately $9.3 billion. What makes this particularly striking is the pace of accumulation. In September alone, Bitmine acquired $1.3 billion worth of Ethereum across multiple purchases. But Bitmine isn't alone. Sharplink Gaming, the second largest Ethereum treasury company, holds 837,230 ETH worth $3.7 billion and has already raised another $537 million to buy more tokens. Together, these two companies have purchased nearly 2% of all Ethereum in circulation in just about 90 days. This aggressive institutional buying is creating what analysts call a supply squeeze. Wintermute, one of the largest market makers, has reported they have almost no Ethereum left for over-the-counter sales. When you combine this with the 35.8 million Ethereum currently staked, about 30% of total supply, available liquidity is becoming increasingly scarce. The impact on price sensitivity is significant. While it takes around $135 million of capital to move Bitcoin's price by 1%, Ethereum is roughly twice as price sensitive, meaning it takes less than $70 million to achieve the same 1% price movement. With institutions buying at current levels, this creates the potential for explosive price moves on relatively modest additional buying pressure. And if you want to stay ahead of these institutional moves and understand exactly when market conditions are shifting, I break down the latest developments every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. You'll get insights on everything from treasury company buying patterns to when the market is getting overheated, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Now, while treasury companies are buying up Ethereum at unprecedented rates, another reason Kevin has become so bullish on Ethereum is because of stablecoins. What's driving the institutional interest in Ethereum becomes clear when you examine Ethereum's role in the stablecoin ecosystem, the foundation of O'Leary's thesis about Wall Street going on-chain. The numbers tell a compelling story. Ethereum's stablecoin supply has exploded to a record $165 billion in September 2025, adding $5 billion in just 1 week. This represents the fastest pace of stablecoin growth ever recorded, with the network absorbing nearly $1 billion in new stablecoins per day. This isn't just about speculation, it's about fundamental infrastructure adoption. Stablecoin transaction volume reached $3 trillion in August 2025 alone, a 92% increase from previous periods. More importantly, Ethereum processes approximately 70% of all stablecoin settlement volume globally, cementing its position as the primary blockchain for dollar-based digital transactions. The regulatory environment has been crucial to this growth. The Genius Act, signed into law in July 2025, provides federal regulatory clarity for stablecoin issuers and explicitly prevents them from being denied licenses for using public blockchains like Ethereum. This has removed a major barrier to institutional adoption and created the framework for traditional finance to build directly on Ethereum. The business model implications are significant. Stablecoin transactions now account for 40% of Ethereum's total blockchain fees, creating a sustainable revenue stream that supports higher valuations. With stablecoin usage expected to continue accelerating, this fee revenue could become one of the most reliable cash flows in the entire crypto ecosystem.
So you're really trying to capture three momentums. One is Bitcoin is here to stay, and it certainly seems to be a store of value, number one. Number two, Ethereum is probably the platform right now that is getting Wall Street on chain and certainly providing for transactions with stablecoins, which are now legal all through the United States. And together, they provide yield.
This quote encapsulates the investment thesis perfectly. Bitcoin serves as the digital store of value, Ethereum provides the infrastructure for financial services, and together they can generate yield while appreciating in price.
And so, why bother owning anything else? That's my view. I mean, you think about the performance of Ethereum over the last 3 months. It's been phenomenal. So 2,000 and change to 4,000 now. Why? Because of, I think, the passing of the Stablecoin Act, the Genius Bill.
The performance O'Leary references reflects the market's recognition of Ethereum's fundamental value in this new regulatory environment. From around $2,400 in June to over $4,500 currently, Ethereum has nearly doubled as institutional adoption accelerated following the Genius Act passage. So why might October represent a strategic loading opportunity? Several factors are aligning that suggest current price levels may not last much longer. First, institutional buying patterns show no signs of slowing. Bitmine alone has stated its goal of accumulating 5% of Ethereum's total supply. They're currently at about 1.8%, meaning they could potentially buy another 3.2% of all Ethereum in existence. At current prices, that would represent over $15 billion in additional purchasing power hitting the market. Second, the stablecoin growth trajectory continues accelerating. With $165 billion already on Ethereum and McKinsey analysts projecting the global stablecoin market could reach $2 trillion by 2028. Ethereum's dominance in this space positions it to capture a disproportionate share of that growth. These are the main reasons why Kevin has switched half his crypto positions into straight Ethereum.
So you don't have to be an expert on, understanding 10,000 tokens and how they work together, any of that anymore. In my view, and what I'm doing is just simply owning 2 of those, making them work together, getting a distribution every month. I'm pretty happy with that outcome.
This simplicity is perhaps the most compelling aspect of O'Leary's approach. Instead of trying to pick winners among thousands of speculative projects, focusing on the 2 assets that capture 90% of crypto's fundamental value proposition while generating yield provides both upside potential and downside protection. Based on O'Leary's analysis and the institutional trends we've examined, here's how to think about positioning for the months ahead. First, consider the allocation approach O'Leary uses. 50% Bitcoin, 50% Ethereum, plus stablecoins for liquidity. This provides meaningful crypto exposure without taking portfolio-destroying risks. The key is treating these as long-term strategic holdings rather than trading positions. Second, focus on the yield generation strategies O'Leary emphasizes. By wrapping Bitcoin through Ethereum protocols, you can earn distributions while maintaining price exposure. This transforms crypto from purely speculative assets into income-generating investments. Third, pay attention to the supply dynamics we've discussed. With institutional treasury companies aggressively accumulating and staking levels near 30% of supply, available Ethereum is becoming increasingly scarce. This creates favorable conditions for sustained price appreciation as demand continues growing. Fourth, recognize that the stablecoin infrastructure play is just beginning. With $165 billion already on Ethereum and regulatory clarity now established, the growth trajectory could continue for years. This provides fundamental support for Ethereum's value proposition beyond just speculative demand. The bottom line is that O'Leary's simplified approach, focusing on just Bitcoin and Ethereum while generating yield, may be exactly the right strategy for navigating the current market environment. Rather than trying to pick the next 100x altcoin, concentrating on the assets that capture 90% of crypto's fundamental value while earning monthly distributions provides both growth potential and risk management. Whether October proves to be the optimal loading opportunity depends on how quickly institutional buying accelerates and when the next wave of regulatory clarity arrives. But the structural trends supporting both Bitcoin and Ethereum appear to be strengthening rather than weakening. The crypto market is evolving from speculative mania to institutional adoption, and the investors who recognize this shift early will be best positioned for what comes next. Whether you follow O'Leary's exact approach or adapt it to your own situation, the key is focusing on quality over quantity and building positions in assets with genuine institutional demand. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.